TheoTrade. This is Don Kaufman. July 2nd, 2021. We are minutes after the cash close here on this Friday afternoon. Of course, coming into a holiday weekend. Markets, well, throughout the course of the week, just ripping to the upside. I mean, this entire marketplace is just all market bull and no market bear. With that, the S&Ps smashed the upper edge of the expected move yet again. For those of you that do tune in on a week-to-week basis, specifically on the weekend update, last weekend's update, I mean, was just talking about exclusively the inefficiencies in the marketplace right now. And anybody that's been in this business for any decent amount of time, you're looking at the marketplace going, yeah, this is getting a little ridiculous. Ridiculous trade to the upside, and that's why I'm saying it's just all bull and no bear right now. Nevertheless, the single most important thing that you're looking at on your screen right now, and remember, me, I'm not a market technician. I am very much quantitative by nature, but that quantitative side of me, you just have to look at the breaches of expected move in 3 consecutive weeks. And that's exactly, again, what we were talking about in last weekend's update, is that breaches of expected move have tendency to, if you will, bring on more breaches of expected move, that we actually go from these periods of incredible efficiency in the marketplace to rather an inefficient state. And that's exactly what we're seeing right now. Now, for those of you that don't necessarily speak geek, we're talking about efficiency, inefficiency in the first minute here of the update. If you don't speak geek, listen, the marketplace, and this is the SPX, and the SPX, it is just the mother of all products, right? Like nothing means as much in the marketplace as the SPX, and that's because it drives a huge amount of order flow. So, and it's not just about options, and yes, the SPX is an option-only product, but the SPX, those options that are traded in here drive the S&Ps. Nevertheless, the expected move, and this is what the options marketplace depicted the movement to be, was approximately $53. Okay, and that was in this past week of trade. We smashed through it. So the week roughly started at this 42.80 handle, and here we are. Okay, roughly closing at 43.52. So once again, smashing the upper edge, if you will, of the expected move, and it's now highlighted. Of course, we highlight anything that is a breach of expected move at the end of the week. So from a probability point of view, you're supposed to be inside the expected move some 68% of the time, except when you start getting 3 consecutive breaches. The important takeaway from this, okay, first of all, it's not just inside of the SPX that's breaking the expected move. Let's actually cruise over to the QQQ. So if we go to the QQQ, and we'll actually highlight into the QQQ, and the QQQ has actually been the laggard on the year, but you're actually looking at literally, okay, 2 breaches in a row for the Qs. What are we looking at in terms of other major index products? We can take a look at the IWM. Now, here is something very, very interesting, because the IWM has literally been Mr. Toad's wild ride lately, but had some huge breaches, okay, in the previous 2 weeks. And this week actually closing inside the expected move, but the lower edge, again, the lower edge of the expected move. I think the thing that is probably most shocking and, most unexpected is not that these breaches came to the upside inside of the SPX, okay, but 3 consecutive breaches, again, 3 consecutive breaches inside of the SPX, when not every other index product breached. What I'm basically saying is the SPX ripped through the upper or lower edge of the expected move in the last 3 weeks. But what's shocking is the divergence, if you will, in the other major index products, and that and therein lies, a little bit of a catch-22, if you will. So before I go any further here, and again, we always like to give you kind of a quick market update, just taking a look around the screen at a couple of different products, and there are some standouts in here. Of course, again, we're relating this a tremendous amount to the breaches of expected move. When you start looking, though, at individual sectors, and we're going to talk a little bit more about things like financials, you have to have respect for the fact that the S&Ps this week, again, they broke to the upside of the expected move. Okay, the financials were not involved at all. The financials are unchanged on the week. Okay, so what was the catalyst over here? You have the financials. We tend to look at the financials, okay? And whenever we bring up the financials, we also bring up the energy sector. If we take a quick glance at the energy sector, what did the energy sector do on the week? And the answer was actually outside the lower edge of the expected move, came back in, but the energy sector actually finished lower on the week. So now you've got this wild and perplexing trade that the energy sector, okay, plus financials, that's been a pivotal trade lately. Okay, it's been a pivotal trade that's really moved markets. Not this week. This week, pretty much the entire week belongs to none other than the monsters of tech. The monsters of tech, okay, exploded to the upside. And when I say the monsters of tech, I'm not even referencing just the QQQ. As I said a moment ago, yeah, the Qs definitely approached and broke to the upside, but the monsters of tech, that's this complex of Microsoft and Apple and Facebook and Amazon and Google compiled together. Not even Tesla played a role this week. Moot point. Tesla didn't play a role. It's all about the monsters of tech. Okay. And then there were what? Okay. You got 5 underlyings once again running the marketplace. Nevertheless, for continued upside, and I already want to kind of foreshadow into this, for continued upside in the marketplace, unequivocally, you will need the financials to play into that. And we're going to look at that here more in just a moment. Now, okay, another really kind of wild aspect specifically of today's trade. Let's not look back at the whole week, but of today's trade. One thing I do want to show you for those of you that again kind of speak intraday trading geek about this. So the S&P is flying to the upside. The Nasdaq up another 160 handles, over 1%. You do realize the VIX was climbing in the midst of that. Now, if you don't speak VIX, okay, maybe the volatility futures might do a little bit better for you. So the reason that we're mentioning the VIX, and the reason we're mentioning like the volatility futures in this respect, and I'm going to bring this up a multitude of times in this session here, is that most of your volatility products you would think would be down quite significantly with such wicked rallies. None of them are down quite significantly. In fact, you've actually got volatility rallying, okay, with the marketplace rallying. And for those of you, again, that are a little bit more quantitative by nature, it can in fact be, it's not definitive, but it can in fact be volatility going up with the marketplace going up in subsequent days. You could actually have the signs of a blow-off, if you will, inside of the marketplace. So this is literally trade that gets so furious to the upside that we actually start to perpetuate volatility to the upside of the marketplace. It is incredibly rare, people, incredibly rare to see the volatility futures bidding up, okay, with the S&Ps bidding up. I mean, we're talking about, you'll see this a few times in a year at most with this kind of a wicked rally, especially given the fact that we're coming into, again, it's holiday trade. I mean, Monday, the marketplace is closed. So coming into the July 4th holiday, July 5th, okay, is actually the market holiday, if you will. So on Monday, the marketplace will be closed. We're coming into a 4-day trading week. I get it that the S&P volume is inherently low, so volume is off over here, and everybody's like, "That's it, it's holiday trade." Yeah, well then why did trade come rushing in to actually buy some volatility throughout the course of the day? And again, perplexing, absolutely. So that was just in today's trading session. I don't want you to believe that volatility has been going up, because volatility hasn't been going up, but volatility caught a bid in today's trading session with the marketplace ramping up, which again can very well be that sign of it's a fever pitch, and you can feel it, you can taste it, you can smell it in this marketplace. Moving on over here in terms of our theme of all bull and no bear, low volatility. Do not let low volatility fool you for a second in here. And again, I want to talk a little bit about, without completely geeking out, we'll talk about like contango and backwardation, but the low VIX. Yes, the VIX is low versus where it has been since the onset of COVID. So we're at the lowest point. I say this all the time. We're at the lowest point of volatility in the last, 16 months. You can see the VIX spike at the onset of COVID. The VIX has actually backed off. But I'm telling you right now, the VIX, and I always say this, is like my predecessor's volatility indicator. Nevertheless, the VIX doesn't tell the whole story. Why doesn't the VIX tell the whole story? One of the first things you're missing is if you take a look briefly at the VIX and you look at like VIX options do not price off of the VIX. The VIX options actually price off of the volatility futures. There's something that's going to keep you up late tonight. Anyway, the VIX and the volatility futures. Okay, the volatility futures are technically the underlying, like this July volatility future. Okay, is like the underlying for the July VIX options. But here's the really, really crazy part. As I put on here, I said volatility futures are in a massive contango. You're like, what does that mean? Look at the difference, okay, between here's July, and July is trading for what? 1745. This is like the forward VIX, if you will. And then you look at something like August, okay? August is trading at 1950. I can go even further than that, but that is a 2-point differential. But what I'm saying is that the August version of like, what, VIX is trading almost at 20. Spot VIX, which is the actual VIX, is trading at 15. That is a huge, huge contango though between July and August. I mean, just I've seen a lot of 2-point contango, but it gets even crazier. Like the further you go out in time, like this volatility futures, the curve out there, it's as steep though as it's ever been, which effectively means that right now, here we are in low volatility land, and that's now. But in the future, they're pricing in dramatically higher volatility, which people, you got to understand what this means. Like, I know that people want to go out and they want to go into the VIX and they want to go like, I'm going to buy me some VIX options and hope that the marketplace tanks. Yeah, except that these VIX options, they're already pricing in that the marketplace is going back to like a 20 volatility. You just have to look at the option chain, and I'm showing you right now. In fact, when you go out to September, here's September, this is like the at-the-money options close to the 21 strike, right? Put call parity over here. Look at the price of the calls, look at the price of the puts. If they're about equivalent, you have put call parity. So what I'm saying is, again, the future of volatility is substantially higher. So I don't need to sit here and preach to you that like, hey, volatility is going back up. Marketplace says it's going to go back up. Does that mean it can't, just subside? No, it can. But right now, the marketplace continues to price that volatility is going to go back up. Here's the other crazy thing about volatility. And again, there are some unusual occurrences here, people. Since the onset of COVID, the VVIX has only gotten below the 110 level. 110 is a serious level inside of the VVIX, right? But it's only gotten below the 110 level for a few days here and there. The VVIX, though, won't back off, which is indicative of there's still traders coming in here and starting to hedge. Okay. Last but not least on this particular front, all right, we have what we term skew. Skew continues to be the talk of the trading community. Now, why? Well, because skew is effectively at all-time highs. So this is out-of-the-money puts versus out-of-the-money calls inside of the SPX. Skew is at incredibly high. In effect, it allows you to, I guess the best way to say this is if you look at a marketplace, I'm actually going to draw this up here because I think it's this important to actually understand. If you look at a marketplace, and I always like to represent a marketplace, like this, and I'm going to use the SPY, and the SPY is trading at 433, and you look at like, what's the chance of going up here versus down here, and what's the probability of getting up here versus down here, and what's the probability of going all the way out here? What's all the way out here? That's like what we call a 3 sigma move, 3 standard deviations outside. And the answer is skew says that there's an incredibly high probability of making like these 3 sigma moves. And we all know, from experience that pricing in a 3 sigma move, like it's next to impossible. Like, what are you going to try to do? Handicap the next crash of the marketplace? And yet that's one of the things that skew is doing. I mean, skew has been clear up to it hit, 160, 165, let's call it 170. It's insane. So it's actually pricing in this wild and woolly tail risk over here. You know what I say? I say, sell it. Sell the skew and hedge. That's the game plan right now. In fact, I'm going to get more into a strategy session here momentarily. So big time skew is still prevalent. So the marketplace is anticipating, if you will, more volatility by means of looking at VIX and by looking at VVIX and by looking at volatility futures. We assume that the marketplace is anticipating more volatility, but then we also have these wild hedgers out here that are, the skew is jacked to like 170. Everything points again to more volatility. Now, completely and utterly changing gears over here. I actually want to take a quick glance at the TNX. Okay, this happens to be the 10-year. In fact, I'm actually going to look at the 10-year right now for the last 20 years. I think a trend is forming. The interest rates are headed to zero, maybe, possibly. Okay, but that's really not the point of me bringing this up. In the 10-year, one of the things that's surprising is like the unemployment situation. The numbers came out today, and the unemployment situation, it was over 850,000 jobs created. It was a better than expected number. And the surprising thing, okay, is that the market, specifically in terms of interest rate, and this is the interest rate, fell. Okay, and the rates in just the last few weeks, and that's exactly what my line is drawn on. Okay, came all the way to 1.76%. We're all the way back down to about 1.43%. So interest rates have actually declined, which, if you think about this logically, the economy is getting better. Why are interest rates declining? And I'm actually just going to give you a very, just kind of off the cuff, nothing definitive in here, but I think that interest rates, price this in, they overshot. They overshot considerably in the beginning of the year, and they just pulled back in a little bit. I wouldn't look any further than that. People are trying to describe, well, it's the yield curve, it's this, it's that. How about this? Okay, the marketplace recognized all the stimulus that was out there. Okay, the rate exploded up with anticipation that maybe inflation really was there, and kind of overshot, and it's pulling back very, very slightly. Again, I would not read into the interest rate, component of this any more than that. Nevertheless, if interest rates do continue to go down, and I'm not positive that they are going to continue to go down, but if interest rates continue to go down, it should negatively impact the financials. We need the financials to keep the S&Ps higher. The S&Ps right now are absolutely smoking. That's predominantly, though, because they went in there and bought the monsters of tech with both hands. Okay, but if you take a look again in terms of auto expected moves, how many weeks in a row did we head down? We popped back to the upside, but we did nothing, kind of moderate. This coming week, I know we have a 4-day trading week. I know it's coming out of holiday trade, but this next 4-day week, it's fairly pivotal for the financials. Okay, with that, the energy sector is right in tow. The energy sector kind of flattened out, and it is considerably lower, all right, over the last few weeks of trading. So again, the energy sector is already taking degrees of hits, and again was outside the edge of the expected move, bounced back in on some OPEC news. Nevertheless, we do have some sell side activity that has been persistent inside of the energy sector. Energy, okay, plus financials. If they start to sell off any further, it is not only going to stall the S&Ps out, but will actually start to crater the S&Ps and pull them back in a little bit. Again, that kind of bearish news has been nowhere to be found. With that, a little bit of a bond outlook. Whether you like the bonds or not, okay, they are very close to breaking to the upside. Now, I don't want to look at this chart and try to discern anything more, okay, then the bonds are at a fairly pivotal level. A break to the upside, though, in the bonds, and I want to give you this kind of an outlook in here, a consideration, if you will. A break to the upside in the bonds, okay, is probably going to really do some damage to the financials, because it's going to take, again, those interest rates even lower. So as rates actually head lower, the XLF is probably going to head with it. All right. Again, this next week of trade is fairly pivotal on that particular front. Nevertheless, I'm actually looking at the bonds as a trade opportunity, which I'm going to get to here momentarily. Okay, so with this information, a little bit of a strategy session in play. In this strategy session, I just want to talk about the marketplace as a whole, and the fact that, again, you have the S&Ps all-time high. It's just a blistering move again to the upside, right? You have the QQQs, which everybody's screaming all-time high. One of the things that you want to be aware of, if you look at the QQQ is up roughly 16% on a year-to-date basis. The spiders are actually up over 17% on a year-to-date basis, and the IWM, the little engine that could, is flat. Nevertheless, it has been flat for weeks, still up some 18%. So one of the things that you've now seen is the QQQ just played catch up, okay, with the other major indices, but the Qs are still the underperformer in here. Lo and behold, the financials are actually up 27% on a year-to-date basis. And that's why I'm telling you right now that I put so much emphasis, okay, on the bonds, because if those bonds do break out to the upside, Okay, it's good night financials. 27% can get cut in half, literally, almost overnight. In the strategy session, though, over here, I'm going to make this simple. I'm going to sell premium. I'm going to sell premium, and I'm going to continue to sell premium simply because the skew is beneficial to do so. The other thing, though, is I'm going to be shifting some risk to underlyings with higher implied volatilities. One of those happens to be none other than the bond product. If you look at like IV ranks and IV percentiles, this is actually an IV rank. The bottom line is, if you're looking at the TLT, implied volatility is decent inside of the TLT, right? If I actually brought up the spiders, where's implied volatility? Like absolutely rock bottom. This is actually the IV rank inside of the spiders is rock bottom. But even though implied volatility is inherently low inside of the S&Ps, the out of the money puts are trading for a phenomenal level, phenomenal volatility, just given the fact that they're skew. That's why looking purely at volatility is not telling you the entire picture. So again, I am going to be selling out of the money premium, and I have been selling out of the money premium. And I'll tell you what, we've been completely and totally unscathed. So ladies and gentlemen, we got through the first 6 months, of this year, 2021. There was one losing position for a matter of pennies. Any other losing position in the TheoTheo portfolio was a hedge, and we use hedges as sacrificial lambs. We anticipate to lose a little bit of money on a few VIX hedges. Nevertheless, we got through completely unscathed in a strategy session for the back half of this year. We're going to continue to sell premium. We're going to shift a little bit of risk, again, to some underlyings, not all of it, but we're going to shift some risk to alternative underlyings, things like bond products, and we're going to mitigate downside exposure with VIX vol spreads, meaning that, yes, the VIX is low, okay? Nevertheless, we're actually using kind of a funky little VIX volatility trade in the event. What if the marketplace crashes? Well, that volatility will likely explode. If it does, our VIX volatility spread will make money and mitigate exposure of what we've actually sold. Last but definitely not least, one of the most critical aspects in this marketplace, okay, without unequivocation, you're seeing volatility go up with the marketplace going up. You're seeing 3 consecutive breaches of expected move. Like, what else do you need to see over here? Risk is very clear and very concise. However, this is one of the craziest things probably to talk about on this update. And that is the fact that if you look out to next week's expected move, right? So it's only going to be a 4-day trading week. Again, the market is closed on Monday. They have the entire week pegged, okay, at about a $42 expectation. You'll notice, okay, I didn't even have the expected move in here yet, and that's because, well, but when I was starting to actually shoot this, the expected move hadn't settled out. So we're looking at a $42 expectation of movement. Now, why is that so important? Last week, we had a $53 expected move. We shattered it. The week before that, we had a $90 expected move. We shattered it, right? How many times in a row? And the week before that, it was like a 60 some odd dollar, expected move. We shatter it. How many times in a row do we shatter the expected move before they start getting the pricing right? So the irony is we're getting huge price action right now inside of the S&Ps, but the implied volatility is crushed in front month. A moment ago I was talking about selling premium. If you're going to be selling premium, you're like, oh, I don't want to sell premium in an 8% implied volatility. I don't disagree with that at all. I don't want to sell an 8% volatility either. Back month options are still rocking. They're still all the way out there, close to 18 or 20% implied volatility. And that is what the TheoTheo portfolio is about. That is what Ultimate Trades is about. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.